Hello traders, today is the 18th of March. My name is Devil Hornsey, market analyst YouTrading, and today I'll be looking into how to trade the inside day chart pattern. Okay, before we actually go into the charts, going to look at the heat map. We can see here that the euro is currently the weakest currency, along with the yen and the Chinese yuan. If you look to the Swiss franc, that seems to be the strongest, and the yen is obviously weak. So opposing safe havens here. So risk on, yes, because the bottom left-hand corner is turning green, top right corner is turning red, but with the safe havens opposing each other and a mixed US dollar, we're basically trading on news headlines still. Going into the charts, look to the top left-hand corner, we've got the dollar versus the yen, active trader platform sentiment indicator. 96% of the traders are trying to go short this dollar yen. So we're expecting to see prices go higher just to stop them out. When they flip to being neutral to bullish, then maybe this bull trend finishes. Now, going to trade the inside day, obviously. An inside day occurs when the candlestick of one trading day's high and low falls within the boundaries of the prior day or day's high and low. So we're going to call that inside day the child, and the outside sort of range, if you like, the mother. So the mother forms, this was the FOMC day. So we had a bullish dollar yen day. Then the next day, which was yesterday, we had the child form, and traders basically waited for the Bank of Japan, which announced that their monetary policy meeting was going to sort of keep monetary policy exactly the same as it was before. So the Fed, they're increasing their rates. The Bank of Japan are going to keep theirs negative still. So we want to be long the dollar, short the yen. So today, London Open, obviously traders started to go long based on the fact that monetary policy divergence was still occurring. Now, some traders would have bought the breakout and they would have their stop below the mother's 16th of March low, and they'll be risking from there 118 all the way up to 121 for a risk reward of 1 to 2. Now, if you were to trade breakouts in this sort of manner, you have to be careful of fake outs and being trapped. Now, obviously, if we just go back to the context, like I said, 96% of the traders are trying to short this. That's been quite consistent really for quite a while. If we look, we've got the daily 20, 50 and 200 EMAs all pointing higher at the moment. They've been stacked bullishly since September 2021. We have had higher lows and higher highs on the swings. So price action and momentum to the upside. This momentum is probably going to keep pushing price action to the upside for quite a while. Now, so we're looking to go long, but if we were just to take, just a breakout, then we're at the risk of all the way back down to the mother's low. So that's kind of a lot of risk to take on. Yes, it's great if you do get this big move to the 121. And if we look left on the weekly chart and, try and work out where we could be going all the way back to 2016, we've got this high here. So that's a potential liquidity sort of pool, 121.686. Moving back to sort of present day, that'd be above our sort of risk of reward 1 to 2. So possibly a move through the 120 all the way up to 122 is possible. So yeah, maybe it is worth the sort of chancing our arm on the breakout. However, like I said, there is a chance we get faked out and trapped. So how do we mitigate that? Well, if we go down to an hourly chart and just take a look at what actually happened. Like I said, we're in an uptrend since September 2021. This is February 2022. We had the mother candle here from the 22nd. The 23rd was the sort of child candle. Then on the 24th, they did a sweep of the liquidity. So they took out the stop losses down here, then reversed immediately back into the range. Big impulsive move to the upside, pull back to the top of the range before going higher again, and then took out the liquidity up there. Now, if we were to look to the right, traders would have been confused for a couple of days, essentially. We had the expansion of the range, and then sometimes you come back into the middle of this range. So if we just pull that, this is the middle of the range, come back to the middle of the range. We had from the low of this fake out to the high, we had a pull back down to the 78.6 retracement on the fib. Then a second time, but we didn't take out that swing low here. So remain bullish. They left a double top. So we knew the liquidity above there. The fact that we didn't go lower and take out this liquidity and sort of reverse this trend, then yeah, some traders obviously held on for that. And that was the start of this big bullish move. But the traders here who would have got short just on the breakout would have been chopped up many times, I'm sure. So we don't want to trade breakouts. We want to be a bit more sophisticated. If we see a decent clean breakout, then we can be patient and wait for a retracement back down to the swing high, the sort of range high, like we saw back here. We saw a breakout of this high and then a return to that high before it went higher again. So we want to wait for that. So we want to break out, then a retest, a classic retest, and then a continuation higher. Then we can keep our stop loss pretty much around the 119 spot 114. If we don't really get that, if we just get a sort of a poke through, then we want to wait for a retracement back into the range. And then as long as we don't take out this swing low from the mother candle, then we can expect to sort of see higher prices. So we've got the 50% here. So the arrow down to the 50%. If we look to the left, we've got this imbalance from the 18th of March. What do I mean by that? Well, we had a big sort of drop to the downside. So this impulsive candle to the downside. Then we had a base, then a rally, then a base, then a drop, a base, and then a rally. Now, during all of this price action, the price action has tested all the different levels. Whereas here, we've got this gap, which needs to be sort of filled in, if you like. So there's prices and trades left there pending. And sometimes the algos will want to sort of take liquidity, grab some stops, and then come back down, grab this liquidity down here. So this to me would then, at least if I was to put my stop loss underneath the mother candle, reduce my risk to reward, and I could pull that down. And if I'm still targeting, all the way up to 121, now my risk to reward, see here, ratio of 5.18. So that makes it a more asymmetrical trade. Similarly, if I was to actually wait for a pullback to the sort of mother's high and then keep my stop loss underneath the previous swing low, I could also reduce my risk and keep my risk to reward ratio asymmetrical. So that's how I'd like to think about trading the inside day sort of candles. You essentially just need to wait for them. It sort of does set up possibilities. Obviously, we want to we want to trade with the trend, and we want to try and get a small risk to a large profit. All right. Good luck today. It's Friday. If you do make some money, try and go into the weekend happy, and I'll speak to you again next week.